Hello everyone and welcome to another video on accounting. Today we will be discussing accounting for merchandising businesses. Now businesses are divided into three types according to what they do, i.e. according to their operations. Some businesses are service businesses. So a service business sells time or service to earn revenue. Examples are accounting firms, law firms, mechanics, banks, airlines. They all sell you a service to earn revenue. Then we have merchandising businesses. They sell products to earn revenue. So Walmart will sell you a product, for example, a toothpaste, to earn revenue. And third is manufacturing business. These businesses make and sell products to earn revenue. So Toyota is a manufacturer because it makes cars and then sells those cars. Now that's one difference between service business and merchandising business and manufacturing businesses. One way of looking at the differences. Now for us, the important topic is merchandising business. So we will look at that difference more in detail. So let's compare this with the service business. So obviously one difference is service businesses sell you service, merchandising business sell you a product. Now the second difference is how they arrive at the profit figure. So that is how they prepare their income statement, which is a financial statement. So a service business income statement starts with the line item service revenue, followed by operating expenses. These operating expenses, such as rent, salaries, advertising, insurance, are deducted from the service revenue to arrive at a profit and loss. However, for a merchandising business, the revenue line item is known as sales revenue because when a product is sold, it becomes a sales revenue or just simply sales. Now the expenses are divided into two groups. So we have the cost of goods sold and secondly operating expenses. Now the cost of goods sold is the cost of the items that the business has sold. So when Walmart sells you the toothpaste, now it will deduct the cost of the toothpaste from the sales it made to you. That gives you a gross profit. And then from the gross profit, operating expenses such as salaries, rent, insurance, just like in service business, are deducted to arrive in a profit and loss. So that's another difference in terms of how they arrive at profit and loss by preparing income statement. Another difference we can look at is in terms of their operating cycles. So you look at the operating cycle for merchandising business and service business. Now, the first step in operating cycle is that a business starts with cash. This cash comes generally from the owner or can come from the creditor. A merchandising business will use some of the cash to buy inventory. That inventory will be sold in step number three to customers for cash or on credit. If it is on credit, it will become accounts receivable. then then that receivable will be collected to become cash again. So business starts with cash and ends up with cash. Now the aim of operating cycle is that you start with cash and end up with more cash as you complete these steps in the cycle. Now the operating cycle for a service business is that it starts with cash, has no inventory, so it makes the sale, and that sales become account receivable if it is a credit sale, and then it account receivable changes into cash. So there is one less step, and that then one less step than merchandising business, and that is why the merchandising business operating cycle is longer than the service business because of the inventory. Since inventory is a high value asset for merchandisers, we will talk about this a little more. So what is inventory or merchandising inventory? Well, goods that are owned and held by a business for sale purposes are called merchandising inventory or simply inventory. So if a business holds goods to sell them to customers, now those goods will be known as inventory. Now the goods are recorded as current asset until they are sold. And when it is sold, as you just saw in the income statement, it becomes expense, and we call that expense the cost of goods sold. So let's compare merchandising inventory with some other items that the business might have. So remember that inventory is held for sales. So this makes it different from supplies and equipment. Now, the supplies and equipment that are in the business are not for sale, but they are used by the business. So supplies and equipment are not inventory. Since inventory is a current asset and current asset are shown on the balance sheet under the current asset, the balance sheet is also known as the statement of financial position. So you can see the inventory listed as a current asset here. And finally, when it is sold, we just saw that it becomes a line item in the income statement as the cost of goods sold. So let's discuss the accounting methods for inventory. Now, there are two accounting methods or accounting systems to record inventory and keep track of inventory. We have perpetual inventory system and periodic inventory system. Now, a perpetual inventory system will give us up-to-date record of the merchandise inventory on hand and the cost of goods sold to date. In perpetual inventory system, we keep detailed records of every purchase of inventory and every sale of inventory. So the system continuously or perpetually gives us up-to-date value of merchandise inventory that is on hand and how much the business has sold and what would be the cost of goods sold. So these two are always up to date. At any given point, the manager can answer these questions. Periodic inventory, however, relies on physical count. So if a business is using periodic inventory system, it will have to physically count the items in the warehouse to determine how much of the inventory is remaining. And similarly, after the physical count, the business will be able to know how much was sold and what is the cost of that good sold. Now, both systems have advantages and disadvantages. Perpetual inventory system has a better control over inventory because we can immediately investigate when the quantity that perpetual inventory system is showing and compare that to the inventory records. If there is any difference, we can quickly investigate why the difference has occurred. So that's the advantage. The downside is because we are keeping up-to-date figures that requires investment in computerized equipment. So a business needs some scanners, for example, or point of sale system so that it can keep up-to-date figures on the inventory on hand. Periodic doesn't need to invest in the computerized system, so it's less costly. However, there could be some serious disadvantages. For example, first is that there is less control over inventory. So if there is any difference between what is in the inventory, that difference, first of all, cannot be determined easily because there is no up-to-date figure to compare it with the inventory record. Similarly, if there will be slow replies to customer inquiries, so if the customer wants to know about products availability in perpetual system, we will have up-to-date figures to reply quickly to a customer about product availability. However, this is not the case in periodic system. Before we talk about um, more, but just to say that since perpetual inventory system is used widely, we are going to discuss this in our video today. A few things before we delve into the debits and credits for inventory. We need to answer this question: who owns the goods? So here we have a seller, AZ Warehouse, and TM Warehouse is the buyer. Now AZ Warehouse is loading up the truck to send the goods to the TM Warehouse, the buyer. Now, as you can see that the goods, the inventory is on the way. Now, the question for us to answer is, who owns the goods that are on the way? So whoever owns those goods will have to pay for the transportation. and similarly will also pay for the damages incurred. So how do we know the seller owns the goods and will pay for shipping cost? Well, if there is FOB destination, if the terms of the sales are FOB destination, the seller will have to pay for the shipping cost because it owns it. How do you know the buyer owns the inventory and will pay for shipping cost? If the terms are FOB shipping point, that means the buyer will own the goods while on transit and will be responsible for paying the shipping cost as well as any damages that has occurred on the transit. So FOB destination, seller pays because seller owns the goods. FOB shipping point, the buyer pays for transportation because buyer owns the goods. Now, let's look at the debits and credits for the shipping. So from the seller side, when seller pays for the transportation, it is considered as an expense. So it will debit delivery cost and credit cash. If the buyer pays for the transportation, the buyer will add the transportation cost to the inventory. So it will debit inventory or merchandise inventory and credit cash. One last thing before we look at the debits credits is to look at the purchase discounts. Sellers usually offer purchase discounts so to encourage customer to pay early, and they mention the purchase discount terms on the invoice itself. So you might see something like this. So 2, 10 and 30, what do they mean? Well, 2 means that 2% discount or cash discount is available. If the amount is paid in 10 days, 10 days is the number of days discount is available, and means the full amount must be paid in 30 days. 30 days is the total credit period, number of days that the customer has to pay. So how do you read this? It will be 2% cash discount if paid in 10 days from the invoice date. Otherwise, full amount is due in 30 days. We will look at the debits and credits in the purchase discount as well. So let's look at the debit and credit. I am trying to make this as practical as possible so that you know every step of the way. So Walt is the seller and Rob is the buyer. So the manager at Robco, Kathy, is preparing an order for 200 trees, and the price of the tree is $12 each. So it prepared the order, emailed the purchase order to Bob, manager at Walt. Now the question is that when Bob received this order and it says we will work on it, Walt Inc. itself buys each tree for $6 and then sells it to for $12 to customer. So when the purchase order is sent by Rob to Walt, both of them need to determine what would be debit and credit. Well, there is no entry needed for Walt, the seller, because Walt hasn't sold anything. Generally, a sales occurs when the goods are delivered to a customer. So Walt hasn't done that. So no entry. Same is true for Rob, since Rob did not receive any goods. So there is no purchase made, so no entry will be made. Couple of weeks later, Walt Inc. sends trees to Robco. So here you can see the truck moving there, and the goods are being unloaded at the buyer's place. So now, when the goods are delivered, the invoice follows. So Walt Inc. sends an invoice for $2,400 with terms of 2% discount if paid in 10 days. Otherwise, full amount is due in 30 days. So now that Walt, the seller, has delivered the goods, it has made the sale. For that sale, it has not received cash yet because it gave 30 days to Rob to pay. So Rob then becomes a receivable for Walt. So Walt is going to debit account receivable $2,400. Since it made the sale, it will credit sales revenue. So Walt Inc. sends invoice to be paid in 30 days by Robco, so it debits account receivable and sales is credited for sales made. Now, Walt, the seller, must also record the cost of the trees that it purchased. So as you can recall that Walt paid $6 itself to pay the tree, right? To pay for the tree. So it has to record the cost of the sale that it made. So it will debit cost of goods sold and will credit merchandise inventory. So you remember we said that the merchandise inventory is current asset until it is sold. When it is sold, it becomes cost of goods sold, so debit cost of goods sold. And since it made the sale, it no longer has the inventory. The merchandise inventory will be created. So a four-line entry will be made at the time of sale by the seller. What about the buyer, Robco? Well, since Robco received the trees, so it will debit merchandise inventory. And Rob has 30 days to pay Walt. That means it will credit accounts payable. So, so who pays for the shipping? Well, the terms of the shipping are FOB shipping point, and this means the buyer will pay for the shipping. And the buyer will add the $80 cost of shipping to inventory cost. So it will debit merchandise inventory for $80 and cash will be credited if cash is paid. So these are the entries for the seller and the entries for the buyer. Now let's look at the entries. We will look at the entries for returns. So a few days later, Robco returned some trees because they are wrong size. So here it's sending back the trees, and the trees are received back by Walt. So what is Walt going to do? So since Walt received the goods, so that means it did not make that sale or part of the sale. So the part of the sale has been returned by the customer. So it has to debit revenue. However, businesses don't debit revenue. They want to know the full amount of revenue and they want to keep track of the returns. So they will debit sales return and allowance account instead of the revenue account. There are a number of reasons why they do that because they want to track how much of their sales are returned and what the reasons are, and to investigate the reason are there product quality issues or any other issues, so that they can investigate. That's why they debit sales return allowance. Since um, Rob was a receivable for Walt, and some of the goods are been returned, so that part of that receivable is no longer a receivable, so it will be crediting the receivable. And at the same time, Walt is going to make an entry for the goods it received. Since it received the trees are not damaged, so it will put it back as to the inventory. So Walt will debit inventory, and since it did not make the sale, so it should reverse the cost of goods sold also. So it will be crediting the cost of goods sold. What about Kathy? Since Kathy sent back the inventory, so it will credit the inventory account, and Kathy no longer has to pay for the goods that it returned, so it will debit accounts payable. So debit accounts payable for $240 and credit merchandise inventory for $240. Finally, let's look at how it works out to for the cash payment. So it's time to pay the invoice, and Kathy, manager at Robsco, is thinking about paying early to get the discount. So if you remember, there was a 2% cash discount available. So she wants to know if it's a how much that is going to be. So she does a little calculation. So the invoice amount was 2,400. The purchase invoice was 2,400. She returned $240 of goods. So the amount to pay Walt is 2,160. That's the amount due. However, if she pays early, she gets 2% discount, and 2% multiplied by 2,160, it comes out to be $43.20. And so the amount due minus discount becomes $2,116.80. Kathy thinks that it's good to get the discount, so she sends $2,116.80 to Walt. Now, when Walt receives this cash, it will obviously debit cash because it got the cash, but it did not get the full cash. The full cash it should have gotten was 2,160. And why it did not get it? It's because of the discount Walt was offering. So it will debit sales discount for the difference, $43.20, and will credit the account receivable for the amount due, $2,160. What about Rob? So since Rob made the payment, it will credit cash. This payment was made against an invoice, so which was recorded as a payable, so it will debit the payable. So the day payable will be debited for the invoice amount minus return, i.e. the amount due, 2,160. And cash will be paid $2,116.80. The difference is the discount. Kathy will record, as a buyer, will record this cash discount in the merchandise inventory. So debit accounts payable for the amount due, credit merchandise inventory for the discount, and credit cash because the cash was paid. All right, so those are the entries at the time of payment, both by the seller and by the buyer. So hopefully that was easy. So let's just review the entries once more. So the buyer at the time of purchase debits merchandise inventory, credits accounts payable or cash, depending on the terms of the transaction. If it's a credit purchase, accounts payable. If it's cash, credit will go to cash. Um, so if buyer is paying for transportation, remember the terms FOB shipping point, the buyer will add that to merchandise inventory account. So debit merchandise inventory and credit cash or accounts payable. For returns, the return entry is the opposite of the purchase entry. So cash or accounts payable will be debited and merchandise inventory will be credited. And if the payment is made by the buyer within the discount period, so debit will go to accounts payable for the amount, invoice amount minus return. We are going to credit the merchandise inventory for this amount. Here it says debit. That's not a debit. It should be a credit to merchandise inventory, and a credit will go to cash as well for the amount paid. And if it is paid after the discount period, so it's simply debit accounts payable and credit cash. What about the journal entries for the seller? So when the seller makes a sale, it will debit cash if it receives the cash. But if it offers time to customer to pay, so it will debit account receivable. A credit will go to sales revenue. So the third line would be to record the cost of the sales made. So debit cost of goods sold and credit merchandise inventory. If the seller is paying for the transportation, it will be an expense. So debit delivery charges and credit cash. And if there are returns, the returns generally would be the opposite entry of the sales. So debit will go to sales revenue naturally, but businesses do not debit sales revenue. They want to keep track of their returns so that they can investigate the reasons. That's why they debit, instead of sales revenue, they debit sales return and allowance account. And the rest of the entry is the opposite of the sales entry. So credit cash, debit merchandise inventory, and credit cost of goods sold. So when seller receives cash within the discount period, so it will debit cash, debit sales discount as an expense, and credit account receivable for the invoice amount minus returns. Finally, if the seller receives the money after the discount, so it will debit cash and credit account receivable for that. All right, so that was the merchandise inventory. Hopefully, you this video was helpful. Watch it again and practice this more so that you can fully comprehend this. And do watch the other videos on the channel. And I'd like you to um, subscribe to the channel. Make sure you like this, click the like and hit the notification icon so that you are notified of the future videos on the channel. So good luck and I'll see you in the next video.